All right, we're going to talk about inventories and cost of sales. Today, a really short chapter in all, and usually when we get into talking about inventories, people really start to kind of get the gist of accounting because you can visualize the cost flow because we can think about inventory in a tangible way. So the first thing I want to talk about just real quickly is how do we value our inventory? And this goes back to the cost principle in accounting, and that is that merchandise inventory as valued on our books includes all goods that the company owns, holds for sale, regardless of where the goods are located when the inventory is counted. So that's about the location and who has possession. It doesn't matter if you've paid anything for it, it doesn't matter where it is, whose possession it's in, it's yours and it's valued on your books. So, what kind of things do we have to worry about when we're thinking about inventory and what's ours and what isn't? Well, just because it's not in our back room or it's not on our shelf doesn't mean that it's not ours. So, we have to sometimes think about the inventory that is on its way to us. Remember FOB shipping point? As soon as it got on the truck or it got on the boat or it got on the plane, basically it belonged to us. So, we have to think about goods in transit. That's our inventory. Also, goods on consignment. Consignment shops were big back in my day. They're kind of far and few between now, but they're still around. Goods on consignment is when you take something to another location for resale. You haven't sold it to that location. They're not selling it. It's not their stuff. It's your stuff. So you have to think about that. Goods on consignment, and then goods damaged or obsolete. How do we value that? So those are items that require some special attention when we're dealing with inventory. Once again, goods on transit, FOB shipping point versus FOB destination. Remember that an FOB shipping point, freight on board, right? It becomes your inventory. It belongs to you as soon as it gets on the truck. So you have to count it in inventory when you purchase it and as soon as it gets on the truck. But otherwise, it becomes yours down here at FOB destination point when it gets on your dock. When we were talking about merchandising, the difference here is how do we value inventory, and we would have to take care of this transportation cost as a part of our inventory value under FOB shipping point. But transportation cost under FOB destination is simply a freight expense, not a part of the cost of inventory. Goods on consignment. Any goods on consignment is the inventory of the consignor, the person who owns it. And then goods damaged or obsolete. They're not supposed to be counted in inventory if they can't be sold. All costs should be reduced to net realizable value if they can be. So you've got a widget that you normally sell for $100, but it fell off the shelf and now it's dented. Well, you're thinking you might be able to resell it, but you can't sell it for 100, right? So you've got to consider what can I sell it for. Now, sales price really doesn't have anything to do with cost, right? But it's where we're going to get into the concept of lower of cost or market. Because if you think that you can sell it for $50, but that widget originally cost you $60, you've got to reduce your cost value down to that lower of cost or market or net realizable value. All right, what things make up inventory cost? It's everything necessary to bring the item to a saleable condition and location. The only exception is that weird transportation piece. So how do we pick up inventory? Well, it's obviously the cost that we see on the invoice minus any discounts and allowances. We learned all about that in the last chapter. We learned how to deal with purchase discounts, returns, and allowances. Plus any insurance that it takes to get it to you, plus any import duties if you're bringing it from overseas, plus any storage of the inventory. If you have to store it in a warehouse for a while before you can bring it into a resaleable condition, storage is a cost of inventory, and then plus freight. Freight obviously is that one exception if it happens to be FOB destination. All right, internal controls, taking a physical count. You'll see there on the left, most companies take a physical count of inventory at least once each year. I want to tell you that in the real world, for small businesses, a lot of business owners struggle with the concept of inventory. A lot of businesses think that when they purchase their inventory, it's just immediately a write-off or an expense. on their income statement, which you and I know absolutely is not correct. It's why they need accountants. What happens if somebody does that? If they never actually value inventory as an asset, and they always just push it into cost of goods sold? Well, technically it means that their expenses are overstated. That means their net income is understated. And that's not a good thing when you're doing your taxes. The IRS is not going to be very happy with you if they audit you and figure out that you're doing that. Um, Truly, I've got a client that we worked with recently for years. They were ignoring the fact that they had inventory and just reporting everything in cost of goods sold. They kind of started to kind of get into a little bit of trouble. I can't get into details because they're a client, obviously. They came to us for assistance with their books, and we saw they had no inventory, and we're like, why don't you have inventory? And they're like, what do you mean? What's that about? And we're like, well, you have a warehouse full of stuff. Why don't you have inventory on your books? And they're like, we didn't know we had to do that. We thought that when we bought it, it was just an expense. Well, folks, what happened is that we had to go back and amend probably, we had to amend about 3 years worth of tax returns. We had to get a lawyer involved in this. It's a long, long story. We thought we were going to have to go back almost 10 years because we were afraid that fraud, it had the appearance of fraud, and that could be jail time for the client. And if we had to go back 10 years, this is the truth. If we'd had to go back 10 years, they would have owed over $750,000 in back taxes plus penalty plus interest. So it really can be a big item. And this was not a huge company. I mean, this company had gross revenues of about, I don't know, $400,000 a year. Not huge at all. And to have to come up with $750,000 worth of taxes would have just been, it would have bankrupted them. There's no question. We got them past it, which is a good thing, and it was all above board. So that's good stuff. But it's important to think about this. When the physical count doesn't match merchandise inventory count, adjustment has to be made. We talked about that last time too when we talked about the perpetual inventory versus the periodic inventory. Remember, perpetual is when inventory is being taken in real time. Just think of a barcode scanner. Inventory happens every time that thing is scanned, but periodic is based on a physical count at an end of each period and then adjusted. What about internal controls? Pre-numbered inventory tickets. Gosh, do we use tickets anymore? I'd say we have SKU numbers. Counters have no inventory responsibility. That means that the people who are counting the inventory don't really work in inventory. My example with that is Walmart. Remember we said if you've ever been at Walmart at 3 a.m. in the morning, you see all these people around counting all this stuff. Those people absolutely have no inventory responsibility besides that count. They don't work with inventory numbers at all. Counts confirm existence, amount, and quality of an inventory item. So all of those things kind of happen at the same time. Sometimes, I'd say probably in big stores like Walmart, it is absolutely likely that a second count is taken just for verification, and then manager confirms everything that gets counted. So again, under that perpetual system, when we were talking about that, that's Walmart with the barcode scanner. Remember that inventory affects both places, a balance sheet and an income statement, and it is the matching principle that requires that we match costs with sales. This goes back to the fact that when we buy inventory, it becomes an asset on the balance sheet. But when we sell a particular item, we must move the cost of that inventory from the balance sheet over to the income statement with an adjustment to cost of goods sold. Here's the cost flow assumption. Management decisions and accounting for inventory involve the following things. 1, items included in inventory and their cost. That's what's in inventory. We already talked about that. The second one is really the majority of what we're going to deal with in this chapter are the different costing methods of inventory. You'll see 4 of them listed there. Are there others? There absolutely are. They're way more specific and more advanced. This is kind of an overarching view of inventory. But specific identification, FIFO, LIFO, or weighted average, we're going to talk about each one of those in just a second. Whether the inventory system is perpetual or periodic is certainly a management decision, and then the use of market values or other estimates, that gets into the lower of cost or market, which is what we'll finish up with today. Look at the graphic down there at the bottom. It says that about 50% of all companies that have an inventory system are using FIFO, 27% using LIFO, and then the other 23% are using different methods. FIFO means first in, first out. That's probably the easiest one for us to deal with. So we'll end up talking about that one first. And it assumes that costs flow in the order incurred. So just think about that. If I have 4 widgets in production and I number them 1, 2, 3, and 4, and I put them on the shelf as 1, 2, 3, and 4 chronologically, then we would think of selling number 1 first, number 2 second, number 3 third, and number 4 fourth. So it's a first in, first out. The first stuff that came in the inventory is the first stuff that leaves inventory. If you're selling milk, you'd probably definitely want to use a first in, first out method because it makes sense. You might be already thinking, well, what does this matter? Well, if I paid, I don't know, 30 cents for my first gallon of milk and my second gallon of milk, but I paid 45 cents for the third gallon of milk and the fourth gallon of milk, and I put all 4 gallons on the shelf, and then I mixed them all up, what cost do I take the first gallon off of my books and push it into cost of goods sold as? That's really what we're talking about. We don't know which gallon of milk really came off the shelf. We don't know which one the customer picked up. It all has the same SKU number. We don't put serial numbers on gallons of milk, right? Well, maybe gallons of milk, you have a purchase date or a sell-by date. But you understand what I'm saying. In accounting, we don't know which item got removed from the shelf necessarily. So we have to pick a method of how we're going to move that cost out of inventory and into cost of goods sold. Once we get into the examples of this in the group work, you'll definitely see it. Last in, first out does the absolute opposite. So the last stuff that we purchase is what's going to actually come out and go into cost of goods sold first. And then weighted average is what the CPAs love because most CPAs are dealing with clients like mine who've never really dealt with inventory and they don't know what they're doing anyway. We just basically take a weighted average. What's the total cost of inventory and how many items do you have in there? We make the division out and that must be the cost per item. So here's an inventory costing illustration. This is where we're going to bring it home, and this is where you'll probably start to understand it. This is information about the mountain bike inventory of trekking for the month of August. So here on August 1, we started with some inventory on hand. It means that this isn't our first month of business, not our first rodeo. We've been doing this for a while. But at August 1, I have 10 units in my inventory, and they cost me $91 a unit. Therefore, my total value of the inventory on August 1 is $910. Obviously, I have 10 units in. But on August 3rd, I purchased another 15 units for my inventory, and they cost me $106 per unit, and that's a total of $1,590. So obviously, if I add these two things together, it gives me my total value of inventory, and I have 25 units on hand. Here on August 14th, I sell 20 units. I charge my customer $130 per unit. August 17th and 28th, I purchase more units at different prices each. By the end of August 28th, I have 35 units on hand. You see that, right? If I have 10 plus 15 gives me 25, minus 20 leaves me 5, added 20 and 10 gives me a total of 35. And then on August 31, I sell 23 units. I sell them at $150 a piece, and I have 12 units left in inventory. Okay. What's all this mean? I had 55 total units available for sale, a total value, right, add all this up, of $5,990. I sold 43 units. I have 12 units left in my inventory. Gosh, that doesn't seem so bad, right? What's all the hang up? Well, the hang up is the fact that I have to transfer money out of inventory and into cost of goods sold. Well, specific identification is the only method that we haven't really talked about even in an overarching way yet. And specific identification means that every item in our inventory has a serial number. We know exactly which items were taken off the shelf and brought back to us. So we know exactly how much each item cost. So let's follow that same example. Here's our initial 10. We bought another 15. Now we have a total inventory value of $2,500. But on August 14th, we sold 20 units. And the company specifically identifies that 8 of them originally cost us $91 and 12 had a cost of $106. That means that we sold 8 of these, and then we sold 12 of these. See what's happening? So I know that I have to transfer that cost level, or $2,000, out of inventory and into cost of goods sold. That's going to leave me an inventory value over here of 500. See the 2,500 minus this cost of 2,000 leaves me a $500 inventory balance. What's now left in my inventory? Well, I'm left with 2 at 91 and 3 at 106 because I sold these number of these. Okay, now on August 17 I add another 20 units. Okay, what's in inventory? I still have this 2 at 91, I still have this 3 at 106, but now I'm adding 20 at 115. If I do that math, my total inventory value is 2,800. All right. August 28th, I buy another 10 units at 119. That's a value of 1,190. What do I have in my inventory? I still have these 3. See, I just repeat it. Now I'm adding in another 10 units at a different price or cost model. My total inventory value is 3,990. I get down to August 31. And I sell some more units. I sell 23 units. And they're telling me over here that I can specifically identify what I sold. They're saying that I specifically sold the 2 units that I had at 91. I specifically sold the 3 units that I had at 106. I specifically sold 15 of these 20. See that? 15 of these 20. And I specifically sold 3 of this 10. Okay, that totals up to a cost value of $2,582 that needs to transfer out. And what do I have left? I have 5 of these $115 units, and I have 7 of these $119 units. And if I do that math, I get 1,408. Specific ID is simple because we know exactly what we've sold, but we've got to be able to trace those, right? All right, so now let's talk about first in, first out. What happens in, first out? First in, first out means that I don't know which items got sold. I can't specifically identify them because, like gallons of milk or loaves of bread or widgets, I don't know which item the customer pulled off the shelf. I have no clue. It all has the same SKU number. First in, first out assumes that the customer is bringing you the oldest item on the shelf, the thing that went on the shelf first. Therefore, when we make that assumption, we're going to push the oldest cost into cost of goods sold first. What does that mean? It means that our most recent cost is what's still going to be left in our ending inventory. Let's watch this. So same data, we can forget kind of all about specific ID because now we don't know which units are sold. Here we are. We start with the 10 at 91. I have a value of 910. I add in 15 at 106. My total inventory value is 2,500. That doesn't change. But on August 14th, I sell 20 units. Because I don't know which 20 units were sold, I have to make an assumption that I sold all 10 of my oldest units first, and then the remainder came from this next set. So I take off the 10 at 91 and 10 of them at 106, leaving me just 5 of these in my inventory with a total value now of 530. Then what happens? On August 17th, I purchase another 20 units, added into my inventory balance. August 28th, I buy another 10 units, I add it into my inventory balance. I get a total value of inventory now at 4,020. What happens on August 31st? I sell 23 units. FIFO assumption says that I sold the oldest units first, so I must have sold these 5, and then the remainder had to come from the $115 price units. The remaining 18 came out of that $115 for my total cost of goods transfer. What does it leave me? It leaves me 2 of these units and all 10 of the 119. First in, first out. I'm expensing out the oldest items first. I have a total inventory balance now using FIFO of 1,420. First in, first out usually jives with most people. Everybody kind of gets it, right? It feels natural to take the oldest cost first. Last in, first out does the exact opposite. It means that the latest items that we put on the shelf, the most recent items we put on the shelf, are the ones that we're going to cost out first. The oldest costs are going to be what's in our ending inventory. So same data. Nothing has changed August 1 and August 3. I started with 10 units. I added 15 units. I still have the same value. It's when we sell it that we have to look at the assumption. Our assumption is now that the oldest unit, that the most recent units come out first. I sold 20 units here on August 14th, right? Sold 20 units. Well, that means that I'm going to take all of this cost first. I'm going to get rid of all 15 of the 106 first, and that only leaves me 5 more to get to the 20. I have to take that from the 91. What's left? The 5 at 91. My oldest cost is what's left at the moment. My inventory balance, therefore, is 55. So I'm just going in reverse order. Instead of FIFO, it's LIFO. I take these first, and then I work my way up. I add in 20, I add in 10, nothing's really changed there except for what my beginning was. 3,945 is my ending inventory. On August 31, I sell 23 units. Okay, well, which units do I need to cost out? I've got to cost out the last in. So I take all 10 of these away, and now I need another 13 to make my 23, so I can take all of that out of the 115 units, right? See what happens? I'm still left with all 5 at 91, and now I'm left with 7 of these units with an inventory balance now of 1,260. It feels kind of weird, right? It's not hard to follow when you can see it tracked like this, but it feels kind of weird. All right. Weighted average, again, is the one that the CPA likes. We just like to take the average cost because usually in my world, our clients haven't kept very good records of their inventory. So we're going to just take the average cost and divide it out. All right, here's what it looks like when we get over to weighted average. My beginning balance was 10 at 91. 910 bucks. Nothing's changed there. When I add in the 15 at 106 though, what I'm going to do is I'm now going to take 10 plus 15 to make 25 units. That 25 units has a value of $2,500. Take the 2,500 divided by 25 units, and that tells me that my cost of value on a weighted average basis is $100 per unit. Okay, so on August 14th, when I sell 20 units, I just apply the cost of $100 per unit. That gives me $2,000. What am I left with? I'm left with 5 out of 25 units with a cost value of $100 a piece. Pretty simple, right? That's why the CPAs like it. So I have 5 units now with a total value of $500. I'm still at $100 per unit. No sweat. On August 17th, I add in 20 units at $115. Well, now we're back to 25 units again, but it has a value of $2,800. If I take this $2,800 and divide it by 25, that's $112 per unit. August 28th, I add another 10 units. Here's what it looks like. Now what do I have? Now I have 35 units, right, with a $3,990 value. If I take $3,990 and I divide it by the 35 units, that's $114 per unit. That's my weighted average. So on August 31, when I sell the 23 units, I simply cost it out at that 114. 23 times 114, I get my cost of goods sold transfer, and I'm left with 12 units. 35 minus 23 is 12 units with a value of 114 per unit. Now I know my ending inventory balance. That's super simple. It creates a little bit more math, right? But it's super simple. That's weighted average. All right. Financial statement effects. Here's what it looks like. So now if we get our sales and we figure out what our transfers for cost of goods sold were, we can see the effect on net income and we can see the value in inventory. Look at specific identification. We knew exactly what each item cost. This is the most exact, right? But not every business can work like this. Not every business has a serial number on every single item. But under specific identification for the exact same information across the board, we had a net income of $713. Under FIFO, it was $721. Under LIFO, it was $609. And under weighted average, it was $685. You might be saying, gosh, well, it's not hugely different. What if this was in millions, though, right? $721 million versus $609 million would be a pretty big difference, without a doubt. So don't skew this by relativity. It can be a pretty big difference no matter what. Look at how FIFO has a higher net income than LIFO. Under the assumption that cost of inventory increases over time, meaning a week later stuff's going to cost you a little bit more. A month later stuff's going to cost you a little bit more as you buy new inventory. If you can make that assumption, then this will always hold true. FIFO is always going to produce a higher net income than LIFO. Well, what are we taxed on, folks? We're taxed on our net income in business, right? So doesn't it make sense that if you want to lower your taxes, you would assume a LIFO method? Yeah, that's how a lot of people think, but in the real world, that's not how it's supposed to work. You're supposed to pick the method that you can justify the best. Can you specifically identify? If you can, you should use it. Are you selling milk? Because if you are, you should probably be using FIFO. Are people typically taking stuff off the shelf that you put on more recently? If so, you should be using LIFO. Does any of it matter at all in a particular business? You should probably be using weighted average if stuff just gets crazy mixed up. You should justify the method. Look at the inventory values. The same thing obviously happens. As it's higher here, then our inventory value is also going to change quite substantially. So our inventories can be different as well, and you might say this isn't much difference, but if this is in millions, right, that makes a pretty big change there, right? That would be a $240,000 bust, right, without a doubt. So it can make a pretty big difference in there. And again, it's all about assumptions because we just don't know what the customer's taken off the shelf under these three methods. All right, the advantages of the methods. Of course, first in, first out says that our ending inventory approximates the current replacement cost. Do you get that? Because I took away, right? I took out of inventory the stuff that I bought first. That means what's in my ending inventory approximates the replacement cost of my inventory. It basically, my inventory is the last stuff that I added. That kind of feels good because that gives it my inventory kind of a real value. But last in, first out kind of better matches current cost with revenues. That's the matching principle. Generally accepted accounting principles say that we're supposed to match cost up with the revenue in the appropriate period benefited. So if I'm selling something today, then I kind of want to use the cost of that thing today. So last in, first out goes better with that principle. Weighted average just kind of smooths it all out. It should fall kind of right in the middle of FIFO and LIFO. So those are just some of the advantages in there. Let me talk to you about this one. Remember how I showed you that LIFO gives you a lower net income? Therefore, LIFO is going to probably give you the better tax advantage. Well, the IRS is keen to this, right? They know what's going on here. So they've identified several acceptable inventory methods. We can use FIFO, we can use LIFO, we can use specific ID, we can use weighted average under any of our tax methods as long as we pick a method and we stick with it. However, if you use LIFO for tax purposes, then the IRS requires that you use it for your financial statement purposes as well. You can't pick and choose methods. Any other case, you could use weighted average for the IRS and use FIFO for your books, or you could use FIFO for the IRS and you could use specific ID for your books. That's all okay as long as you have a disclosure there. But if you use LIFO for tax, the IRS requires you use it for financial. Why? They say that if you're going to use it for tax and get the tax benefit of using LIFO, then your books will have to take that suffer. Well, what does that mean? What do you mean my books are going to suffer? Your net income is going to be lower, right? That doesn't make your books or your financials as appealing to your shareholders or to your vendors, your lenders, whomever, right? So if you're going to use LIFO to get the tax advantage, your books are going to have to take that hit as well. All right, consistency. I just mentioned this a second ago. Once you pick a method, you're supposed to stick with it. That's what the consistency principle is. It says that you have to use the same accounting method period after period so that they're comparable. You can't use FIFO one period because it makes the numbers look better and then change to LIFO the next period because you want a tax advantage, and then go to maybe weighted average because it gives it a whole nother viewpoint. You must pick a method and stick with it. Is that forever? Absolutely not. You can change your methodology in accounting, but you must completely disclose that change, and you really shouldn't do it. If you do it every year, it's going to look really, really bad. All right, lower of cost or market is where we kind of start to finish this up. And remember, I told you that you must keep your inventory at the appropriate net realizable value. And you have to do this when you're dealing with damaged items or obsolete inventory. Here's kind of an example on this. I bought an item for $50. I sell it for $70. It's on the shelf. It's been collecting dust for a while, so it's still kind of sitting around. And someone, picks it up, looks at it, and they drop it on the floor. And now it's got a big dent in it. So, I see it and I'm like, oh, well, maybe somebody's going to buy it. I put it up on the shelf and I put a price tag on it for $30. It's a scratch and dent item, so now it's a $30 sale item. Well, that $30 retail value of that item is now lower than what I paid for it. Right? I paid $50 for it. Now I'm trying to sell it for $30. This rule says that I must therefore then lower my inventory value of that item to that $30, right? I can't have an inventory cost sitting on the shelf with a higher value than what it can possibly be sold for. So that's what we're talking about in lower of cost or market. It is defined as the current replacement cost, not necessarily the sales price, but I have to kind of think about it that way, right? If I'm going to sell it for $30, then most likely I could buy it at thrift store value for $30 as well. Consistent with the conservatism principle, another principle inside of a generally accepted accounting principles, it can be applied three different ways. We can apply LCM or lower of cost or market separately to each individual item. So if I find that one item that I need to look at lower of cost or market, I can do that. Do I have a whole shelf full of stuff that now nobody wants to buy because it's obsolete? Maybe it's all laptops that still use Windows XP, right, which you're not even supposed to have on the internet anymore. What do I do with that? So that could be a whole major category of assets, or it could be to my inventory as a whole, if I just need to lower the entire cost of my inventory as a whole. Here's just kind of a real quick example of this. Motorsports retailer has the following items in inventory. You can see that he has a product level of cycles and off-road. Under each of those product level cycles, he has roadsters and sprints. Off-road, he has tracks and blazers. And look at what's happening. So we can look at, it's easier kind of to see it on the market value. So if my roadsters have a total cost of $160,000, that's what I paid for them, but now the market value is $140,000. I need to reduce the total of all roadsters to $140,000. If I were to add this up, I could apply it the same way. Obviously, this has a value of $210,000. But now if I look at it this way, I have $200,000, so I could probably make all of this $200,000 if I were going at the product level. So you can see that it's a couple different ways. Or I could look at the whole inventory. If I had a total cost of inventory of $295, I could add up the total market and reduce it to that value. This is applied specifically to the items. All right, what happens if we have inventory errors? What does it look like on our financial statement? You can take a look at this. I'm not going to spend too much time trying to decipher it, but obviously inventory errors make some pretty profound changes. If I understate my inventory, here it is. I mean, if I understate my inventory, then my income is going to be overstated, right? I'm going to have too much net income, right? In year two, because you can see kind of what happens here. This is what happened with my client, right? They understated their inventory. They reported a zero, so every single year cost of goods sold was overstated and net income was understated. They had a lower tax effect. We never caught up to it until 10 or 11 years later. So this is what ended up happening as we made the adjustment. So now what happens is in the year that we adjust, net income has to shoot way up in order to correct it. And now they've got this huge tax hit, right? If I had overstated my inventory, it has just the opposite effect. That's basically just what it looks like on the assets and the equity side of things. And that's going to finish it up for Chapter 5.